Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we'll be looking to discuss the whole topic of position sizing. Just before I explain a little bit more in terms of what you can expect over the course of this webinar, please do take a brief moment to familiarize yourself with our disclaimer. You are very welcome to pause this recording so that you have the opportunity to read through this. Okay, so as I was saying, the whole topic for this particular webinar is all about position sizing. So let me explain what we'll cover. So we will start with a brief introduction to what position sizing is. We'll have a look at the relationship between position sizing and effective risk management. We'll look at how to go about position sizing. So there's a number of major topics within position sizing that you need to have a basic understanding of, and one of them is determining the capital risk per trade. Another is to actually determine the trade risk itself. We also need to be able to apply a little bit of accuracy to position sizing, and there's very important reasons for that. Now, in terms of the whole process associated with position sizing, there's a concept of pip location, which you need to have a basic awareness of. Also, what your pip exposure is in the particular trade, the pip value of that particular trade. Having an understanding of the notional trade size is always a very important and useful skill for traders to have at least a basic understanding of. We'll then look at the impact of oversizing and undersizing and how that can impact your trading account balance. We shall then look to put all this together in a very coherent manner, and we shall also just finish with touching upon a principle which is called martingale position sizing. So as you can see, we've got a lot of topics to get through, but I'm sure you'll find them very enjoyable. So let's start with the introduction to position sizing. And let's just start with a definition of what position sizing is. So position sizing refers to the technical size of a trade or the monetary risk that a trader is going to take on any given trade. So for example, investors use position sizing to help determine how many units of a particular market they can purchase. And of course, that has the added benefit of being able to help them control risk and help potentially maximize returns. Now, to just sort of give you a little bit of tip about the whole principle of position sizing, the underlying idea is that you should never place all of your money in a single trade for obvious reasons, but rather put in an amount that is appropriate given your level of experience and of course the level of volatility in the market as well. So there needs to be a certain amount of flexibility there. Otherwise, you risk losing too much too soon. And that's unfortunately what a lot of inexperienced traders experience, where they happen to trade leveraged products. They don't really understand leverage or don't really understand the basic principles of learning how to trade and what's involved in trading. So therefore, they either on purpose or they do through a lack of knowledge and understanding, often oversize or take on too big a position for the amount of capital that they have available. So they very much ignore their experience levels, and then they very much ignore the volatility of the market as well. And if you ignore those two very, very important things, what you can find is a lot of new and inexperienced traders suffer from burning their accounts in a relatively quickly fashion. So the whole purpose of this particular recording webinar is to actually address that as best we possibly can. So in order to position size correctly, and before a trade is executed, a trader needs to decide how much of their capital they wish to expose in a trade. So to do this effectively, they need to consider a few things. The first one is how much capital they want to assign to each trade. So hopefully that's a very straightforward decision that would need to be made. Obviously, we hope you will access a little bit of guidance with regards to that, especially when you're starting out. But the next consideration is, what is the trade risk associated with each trade? Now, we'll look at all of these 3 points in more detail very shortly. And the final consideration is the person calculating the position size accurately? Because if they don't calculate that position size properly, then they may experience some difficulties with regards to the impact that can have on their trading account. So we'll discuss all these in a lot more detail very shortly. So just with regards to the relationship with effective risk management, why is position sizing a crucial part of effective risk management? It's a very, very good question posed. And the answer is because knowing how much of your capital is exposed in a trade or a collection of trades ensures your initial survival, and it impacts your potential for consistent returns. So that is very much the case. If you have an effective risk management strategy when you trade these markets, you're very much likely to give yourself the opportunity to, for longevity, to be able to be in the markets long enough to understand how they operate. And that's very important. So really taking on board an effective risk management approach is a very advisable step for anyone entering this particular environment. And position sizing facilitates a particular role, and a very, very important role with regards to a trader's overall risk management approach. Okay, so just looking at each of those in one at a time. When it comes to determining capital risk per trade, before a trader can access the appropriate size of a trade, they first need to determine how much of their capital they wish to assign to each trade. So this is actually a lot easier than perhaps what it sounds. This is typically a percentage of your account balance. So an average trader, or sorry, should I say an average percentage per trade for a retail trader is roughly 2%. So that is the percentage of a retail trader's account that they on average are prepared to risk per trade. So really a variation of that would certainly be in the realms of it would certainly be in line with many other retail traders in this environment. So the next point is to just be able to calculate perhaps a 2% monetary size of your perhaps a 2,000 US dollar trading account balance. So what that would mean is if you calculated 2% of your $2,000 account, you would come to a conclusion very, very quickly that you will actually be risking, you'll have a capital risk per trade of $40. So that's if you work on that basic principle. So the basic calculation of that is simple. It's your account balance, which is $2,000 times 0.02 or 2%, and that will give you your monetary trade size for that trade. And various different markets, some are actually more expensive than others. But if you work within a monetary amount, then obviously you can decide whether you can take that trade or not. So the benefits to lower percentage risk capital per trade simply means that you could experience, for example, 10 back-to-back losing trades in a row, and you would still have 80% of your capital intact. So that is a very, very important benefit to trading at smaller percentages, rather than obviously trading at 10% per trade. 10 back-to-back losing trades under such situation like that, you'll have burned your account by that point. So it's about longevity and giving yourself every opportunity to be in the markets long enough to learn how to trade them. And to do that, it's very much advisable to trade at lower percentages of your account balance. Okay, so in addition to determining capital risk per trade, we also need to be able to determine trade risk per trade. So there's the slight variations. So a trader also needs to determine the risks associated with each individual trade. So what we mean by this is accurate assessment of the probability of a positive outcome. So this is where your trading strategy comes into play in terms of what trade you're looking to identify. And you just need to ask yourself, is there enough reasons in place to enter this particular trade? So that's an assessment, that's an independent assessment. Hopefully, and the more objective you can be in that assessment, the more consistently profitable you are very likely to become. So it's really stacking the odds in your favor, making sure that you do possess a number of very significant reasons to get into that trade. Some would be slightly higher probability than others, and it's a case of gauging that probability for a positive outcome. So this aspect of being able to determine trade risk it unfortunately comes from gaining more experience. So the more experience you have in these markets, the easier this process becomes. Decisions must be made to determine precisely where to place a stop loss as well. So it's not an arbitrary amount. It's not something that shouldn't necessarily be a one-size-fits-all. It should really depend on what approach you decide to adopt when you're trading these markets, and what your approach is to risk management and placing stop losses, which is obviously drawing a line in the sand to say that if I get into this trade and the market pulls against me, then at this particular price point, I want to be out of this particular trade. And that's just very, very effective, logical, common sense approach to risk management. So, and being precise with that actual price will be very, very useful to you as a trader moving forward. Okay, so that's just looking at the capital risk and also the trade risk itself. And the final piece really is being accurate with that position sizing. So a trader also needs to calculate position size accurately. Or for example, how can I be sure that the size I am trading is correct? That is a very, very valuable question to ask yourself as a trader. So if a trader, as we've discussed, is comfortable to risk $40 in a particular trade, then the trader can now focus on calculating the position size accurately. So once we know what that monetary amount is, then we can start to focus on being accurate when we're executing trades in these markets. So to achieve accurate position sizing, a trader would need to know a number of items. The first thing is the smallest incremental move in that market. So if you understand what a pip or a tick is, then you'll know that that is the smallest incremental move in that market, and that is something very useful for you to be able to position size correctly. Also, your ability to be able to calculate the pip exposure of each trade is very important as well. So we shall explain how to do all of these in the coming slides, which will then in turn allow you to calculate the pip value and what's called notional trade size of each trade. So accurate position sizing is not easy. It's not always easy to do, especially for new and inexperienced traders. So please bear in mind that this is obviously an introduction to position sizing. So there is an awful lot of additional perhaps study that's required, and certainly practice and a little bit of patience to try and obviously get your head around these types of principles. But from an introductory perspective, these are broadly speaking some of the more important topics to focus on when we discuss position sizing. So it's definitely not necessarily an easy thing to do and to achieve and to be very accurate in what you do. But we shall begin to break that down for you as best we can. So just starting with the pip location. So what we'll do with each of these is to give you a brief definition. And the pip location of the market is the same as the smallest incremental move a market can make. So that's whether you're trading either to the upside or to the downside. Now, the pip location varies from market to market. So that's the first thing for you to be aware of. The type of market just listed on the left-hand side there in that box and could include things like the euro dollar. And as you can see on screen, the pip location for the euro dollar is to the 4th decimal place. So that's the case for the majority of the currency markets, apart from yen pairs and some other more exotic instruments as well. But the majority of the currency pairs, you will notice that the pip location for each of those is to the 4th decimal place. So when we talk about the smallest incremental move in the euro dollar, it's 0.0001. Now, just to differentiate and to show you that this pip location varies drastically from market to market. If we're talking about the second one down, which is the FTSE, you can see that the pip location in the FTSE market, if you happen to be trading the UK 100, is 0.5. So that's the smallest incremental move in the FTSE. Again, if we talk about gold, it's 0.01. So that's the smallest incremental move in the gold market if you ever see the price of gold. And to just differentiate between the euro dollar I've also put in the euro yen, and you can see that the pip location is very different to the euro dollar, even though the base currency is the euro. The quote currencies are different. So if you're trading the dollar, it's to the 4th decimal place. If you're trading the yen, it's to the 2nd decimal place, as you can see on screen now, 0.01. So it is very good practice to become acutely aware of the pip location associated with each individual market. Now, pip locations, as we've said, varies from market to market, as you can see. So you do need to have a little bit of caution and be a little bit careful about making sure that you identify what the smallest incremental move of each market is. And you can find a pip location for each market on your broker's website, normally under trading conditions. So that's just a little bit of a review about the pip location. The next important topic when it comes to actually being able to position size correctly and accurately would be pip exposure. So to give you a definition, this is the number of pips difference between your entry price and your stop loss. It's nothing really more complicated than that. Now, it is important for a trader to become acutely aware of the pip exposure associated with each trade. It's just good practice, if nothing else. It's good to be aware about the trades that you take. And this number is specific to each individual trade and can vary, obviously, from market to market. So knowing the pip exposure will help you be able to calculate this position size effectively. And to just touch upon this, you can see in the box on the right-hand side of your screen, we still have our 3 markets. We have the euro dollar, and this happens to be a buy trade. It doesn't matter whether it's a buy or whether it's a sell, but I'll go through one at a time. So let's say we take the euro dollar to begin with, and we have an entry price. We've done our analysis and we identify that we would like to buy the euro dollar. The entry price that we would like to get into this market is 1.2085 to the 4th decimal place. However, we decided to place our stop loss at 1.2040. So if we know and we understand that the pip location of this market is to the 4th decimal place, we can literally take our entry price 1.20585, and we can literally minus our stop loss. And what that means is it will give us a pip exposure. So there's 45 units difference between our entry price and our stop loss. And that is what we mean about the pip exposure. That is something that obviously a lot of traders really don't pay that much attention to. They don't really know exactly what the pip exposure in each individual trade. And we certainly would advocate that just as a point of knowledge and understanding, if nothing else. So just to give you the second example there, we have the FTSE trade. And let's say we decide to sell the FTSE at the 7,260 level. And we decide to place a stop loss above that at 72.90. You would think on the surface that would be straightforward. That would just be a pip exposure of 30 units. And although you'd be correct from a price perspective, you're actually incorrect from a pip location perspective, because the smallest incremental move in the FTSE market is actually a 0.5. So these are both to the whole number. So what you're seeing is at 30 prices higher, but because the pip location is 0.5, it actually means in the FTSE, in this particular example, we have a pip exposure of 60 pips, and that's the difference between our entry price and our stop loss. And finally, on the bottom row, we have the gold market. And let's say, for example, we happen to buy this market at 1225.50, and we decide to place a stop loss $2 lower at 1223.50. However, when it comes to calculating the pip exposure, we want to acknowledge what the pip location is. And in this example, it's 0.01. That's the pip location for the gold market. And what you will see and be able to work out fairly easily is that there is 200 units difference between, so we're talking about $2 in price between our entry price and our stop loss. And when you convert that to pip exposure, it works out as a 200 pip exposure in this particular market, in this example. So that's just a quick run through about pip exposure and potentially how to calculate that. So hopefully you'll find that useful. Moving on to pip value now. So a definition of pip value is the monetary value of the smallest increment in the market you happen to be trading. So this again can vary from market to market and trade to trade. So what you can see up on screen is the same three markets that we've just looked at: the euro, dollar, the FTSE, and the gold. And as you can see, the pip location is as it should be. Now we can assess the capital risk by the process we were speaking to earlier. So let's say, for example, the euro dollar, the capital risk we're exposing is $40 US, and we know that the pip exposure for this trade is 45 pips. We can do a very, very simple calculation to work out what the pip value is, and that is just simply capital risk divided by your pip exposure. So if you take 40 and you divide it by 45, it will work out for you exactly what your pip value is. And that means that each incremental move, either to the upside or to the downside, if you're trading euro dollar at this size, has a pip value of 88 cents per pip movement. So again, this is very, very useful information for you to hold as a trader. So regarding the FTSE, the pip location 0.5, that's important to acknowledge. But in this case, we happen to be trading a $100 trade. So that's the percentage of our capital we decide to contribute to this trade. But this time we have a pip exposure of 60 pips, and that's the difference between our entry and our exit price. But the capital risk is slightly greater. So all we simply do again is we take our capital risk figure, we divide it by our pip exposure, and it leaves us with a pip value of 1.66. So it's basic mathematics, hopefully not too difficult. And the final example there is the gold market, the pip location 0.01. This time we assign an $80 risk to that trade. We understand that our pip exposure is 200 pips from our entry and exit price, and we simply take $80 and we divide it by 200, and it tells us that our pip value for this trade is 40 cents. So that's all very, very useful information when it comes to position sizing. So moving on to something that is also very, very useful for you to know as a trader is notional trade size. And the definition of notional trade size is that it's the total value of a leveraged trade. So those of you that access leverage when you trade these financial markets, the notional trade size is whatever the value of that complete leverage trade happens to be. So when we talk about leverage, we're talking about where a relatively small amount of invested money on your behalf can control a much larger position in those markets. So there are different lot sizes as a result for different markets. Each lot size has an associated notional trade size associated to it. And just knowledge of this will help you work out relevant trade size or volume needed when you happen to be placing a trade. So we'll just very, very quickly just review these different markets, where the type of market we're talking about here are the same three markets that we were looking at previously. We're talking about the euro dollar, the FTSE, and the gold. But if you can identify that there is a different notional trade size depending on the size of the trade you happen to be trading. So if you're trading one standard lot size of euro dollar, what you're actually trading is 100,000 euros, which happens to be the base currency. So that's what you're effectively doing if you happen to be trading one standard lot size. If you took away the leverage, you would need 100,000 capital to trade one standard lot. But because we can access leverage, we can basically we can access this size of trade with much less capital available to us. But when we're talking about notional trade size, it is important to know how much capital you would be trading if you were trading without leverage. So you can also trade what's called one mini lot size. So this is 1/10 of a standard lot. So in this case, it'd be 10,000 euros would be your actual notional trade size. And if you're trading one micro lot, you'd be now trading 1,000 of the base currency. So the same literally applies to the FTSE and the gold. You can see that the standard lot size in a FTSE is to the first whole number, so it's 1.00. One mini lot 0.10, and one micro lot size is 0.01. And just finally there, the gold market If you're trading one standard lot size of gold, the notional trade size you're actively trading is 100 ounces of gold. And if you're trading one mini lot, it's 10 ounces of gold. And if you're trading one micro lot, it is 1 ounce of gold. Again, a lot of this is quite difficult. This is only very briefly a brief introduction to notional trade size. So, and we'll explain it again very shortly when we do a practical example for you. Okay, so what we just wanted to just touch upon before we do this practical example is show you the impact of oversizing and undersizing. So a definition is when you either trade a trade size which is either larger than expected or actually less than expected, then each having their own, as a result, each having their own obvious impact on your trading performance. So it's really about how much capital do we expect to trade with, and is it the correct size, or does it happen to be are you oversizing, or do you happen to be undersizing? So let me talk you through the differences between the two. So if a trader intends to take a $100 trade in gold, but actually realizes once the trade is executed that they've actually realized a $150 loss, then that trader is effectively oversizing. Now, it's on occasion, especially for new and inexperienced traders, that is perhaps an error on their particular behalf. Maybe they don't really fully know or understand that they're actually oversizing, but they are effectively realizing a loss which is 50% more than they intended. So if this is a frequent event, then this trader may burn their trading account a lot quicker than a trader who was trading the actual intended size that they wanted to trade. So that is what oversizing means to the vast majority of traders out there. Whereas if a trader this time intends to take a $1 trade in gold again, but realizes a $75 loss, then that trader is now undersizing and has actually realized the loss, which is 25% less than intended, which on the surface looks like a very good thing because you lose less than you intend. However, if this is a frequent event, then the trader will struggle to see their account grow in an acceptable and rewarding manner, over and above a trader who is trading intended size. So again, it's about just getting that balance right. And I suppose the moral of the story is to try to calculate trade size accurately. And that's what we're actually going to attempt to do right now. So let's put all of this information together if we can, and let's have a look at a practical example on a MetaTrader 4 platform. So for this, I'm just going to get up our trading platform. And we're going to have a look at the euro dollar. This happens to be a live trading chart. And I want to draw your attention to the current price on the top right-hand corner of the screen, which is 1.2379 currently. And just take note as well of our balance. We've got a balance of, let's say for argument's sake, it's just a little under 5,000 US dollars. But let's work with a 5,000 as a particular figure. And what I'm going to do now is to just get this pre-planned bit of text currently up on screen. And I want to take you through this. So let's say we decide to take a 1% buy trade in the euro dollar. So we look at our account balance and we work out 1% of 5,000. So for us, what that means effectively is we want to take a $50 trade in this particular market. So there's our $50 that we know we would like to take. Now we need to acknowledge, so that's the 1% buy trade. We need to acknowledge the pip location for this market, which is to the 4th decimal place. And now we need to calculate what our pip exposure is. So let's say, for example, we look to get in at the current price of 123.79, and we look to exit at a price of 122.79. So we're actually looking to place a stop loss around this particular price. So if the market comes back to this level, we are going to exit that particular trade at that price. So what we can do very, very easily is work out if we take our 1.2379 and we minus 1.2279, we can very, very easily work out that our pip exposure is 100. So that's very, very important to know and very, very important to work out. Now I'm working with just very, very easy numbers to work with. And when we talk about working out what the pip value for this particular market, again, this is quite simple and quite straightforward. We talk about our monetary risk, which is 50, and we divide our pip exposure. And if you take 50, divide it by 100, then this means that we have a pip value of 50 cents per incremental move. So that's very, very useful information to know, because the last aspect to this particular trade size, so we've worked out exactly what the pip exposure is and also the pip value. Now we need to make sure that we're trading at the correct size. So this is where trade size comes into play. So what we do know when we trade the euro dollar, and again, this will come to you in experience, is that if you're trading 1.00 lot trade, which is one standard lot size, you're effectively trading $10 per pip movement. Now, if you were doing that with this particular trade, you'd actually be exposing 20% of your capital. So obviously, for obvious reasons, that is not what you want to be doing. That is a case where you'd be oversizing this particular trade. However, looking at the lower end, if we happen to trade a micro lot this time in the euro dollar and we were trading 0.01 lot, we're actually trading 10 cents per pip now. And what that would mean is we'd actually initially be trading 0.2% of our capital. And again, that is not really what we're looking to do, because we want to trade 1% of our capital, which is actually the $50. So what we need to do is to work out exactly what the trade size should be in this market. So if we know that 0.1 lot or 0.10 lot is £1 per pip, and we know that the pip value is 50 cents per pip, then we can work out very, very quickly that actually on a MT4 platform. So let me put MT4. MT4 on a MT4 platform. We know that if we placed a 0.05 lot trade on a MetaTrader 4 platform, then that is the accurate trade size calculation for a 1% buy trade in the euro dollar, exposing $50 of our capital. With the pip location to the fourth decimal place, we understand the pip exposure and the pip value per trade. So what we want to be doing is we want to be trading at that 1% barrier, which is half of the $1 per pip movement, which is a 2% of our capital. So we want to be trading half that amount, which means when it comes to executing a trade, and I'll just show you here, when you get up the trade deal ticket, we can now put all the relevant information into this particular trade, and we're trading 5 micro lots. 0.05 is how we would effectively go and calculate this particular position size. So this is one methodology to do it. What must be made really clear is that there is a variety of ways to calculate risk effectively. There's a vast number of different types of risk management calculators available out there. So it's just being aware and making sure that you apply that basic understanding when it comes to calculating risk size effectively. So just before we finish then, we do want to raise your awareness of what's called martingale position sizing. So a martingale techniques are used actually by traders to increase the amount wagered per trade as losses mount in order to attempt to cover prior losses. So we'll explain this as best we can. Now, a shocking amount of traders actually believe in this and happen to use these techniques when trading. And it's effectively the doubling down principle. So let me give you a good example. Let's say a trader loses $200 on a trade. He then decides to double his risk once more, thinking he must get it right next time. But unfortunately, now he is down $400. So now he's down $400. He decides to repeat the same and goes through this doubling down process where now he's doubled his loss once more to $800 US, because they're trying to recover those previous losses. So he repeats this again and he sees a continual loss of $1,600 US. He does it again and sees a continual loss of $3,200. And as you can see, this process starts to build. Obviously the capital starts to run dry. However, they repeat this process over and over again. They double down on all their losses in each time. And his final amount is he's taking a loss of $6,400 US, thinking his luck might change this time because it has to. This is, he's taken 5 back-to-back losses. There's no way he can take an additional loss. And then after 6 losses in a row, the trader, if they apply this particular principle, could start off with taking a $200 loss, and you can see how that can exponentially grow to over $12,000 US in total. So this is the basic principle of martingale. Obviously, the risk side is that the trader is looking to double, to get their money back super quick. So martingale proponents forget actually that the financial markets have no memory at all. And because they have limited funds, they can't keep increasing and doubling down forever. And it's always worth knowing and perhaps embracing that a market can remain illogical far longer than you or me can remain solvent. So this trader on this occasion thinks that, I know they achieve a certain amount of successful trades, and there's no way they can take 6 back-to-back losing trades if they apply this technique, and they'll double back their money very, very quickly. And on occasion, that is not the case. So this is a worst case scenario, but it just shows you the dangers that martingale position sizing can create for a trader's account balance. Okay, so that just about concludes this particular webinar. So as you can see, we've covered quite a lot of topics, and this is very much an introductory session to position sizing. A lot more education is absolutely required to be able to get a more comprehensive handle on many of these terms. So all that's left for me to do is to thank you very much for joining us, and we do look forward to seeing you next time. Bye for now.